All right, good morning, everybody. Just a reminder, I am recording today so that if you want to go back and review anything that we've discussed or we've gone through or the problems that we may have done, that you'll have the ability to do that. So that I am recording right now. What I decided to do this morning starting out is a few of you have emailed me some various questions for things happening in chapters 1 through 6. So I'm going to take a look. I'm going to answer those kind of general for everybody so that in case it's a question that somebody else has had also, that we can kind of cover that. Then we'll go through, see if there's any other questions that anybody else has, and we'll go through that. We'll be covering chapters 7 and 8 today. This is class number 4. But we'll be covering chapters 7 and 8, non-refundable credits and capital gains. And then I hope to spend a lot of time at the end doing some problems. So we can do some things within those chapters, even back in chapter 6. I sent out this morning to everybody the answers to the quizzes and exercises from chapter 5 and 6. Sent out the problems in chapter 6. Chapter 5's, I did not send out most of those. Our W-2s with some the refundable credits in there, but if we have any questions on those, I can go through those also. And I know there was a couple questions that have come up about the support worksheet. So for chapter, let's see, I believe it was problem 6.3, I sent out that little worksheet 3.1. I know I've had a couple questions in on that, so I sent that out, and that way too, if anybody wants to talk about how those numbers are done, we can talk about that, okay? Had a question about age requirement regarding child exemption and qualifying child. That age requirement is kind of different between the two. The exemption that you get on there, or the child tax credit, that's where they have to be under age 17. So in the year of their 17th birthday, they are no longer child tax credit. They can remain on your taxes and as exemption to qualify you for the head of household up until their 24th birthday, as long as they are in college, okay? If they're not in college, you create an area where we would have to go into the worksheet that we just talked about, that you would have to decide if you're providing more than half their support, okay? We'll come back to the one on the EIC worksheet, because I'll do that when we bring up one of the chapters there. So we'll come back to that one when I get that one up in front of us, okay? There was a question regarding one of the examples in Pub 17 that talked about a mother and a grandmother living together with the child. So basically a multi-generational home where we have grandma, mom, and a child, okay? To decide where you're going to go, you have to decide, the first thing is probably deciding, obviously, residency. They're all living together. But the next thing is, who's providing more than half the upkeep or the support for the home, okay? As far as claiming who you get to claim, all right? I know it says on there that can the mother claim the qualifying child for EIC while the grandmother claim the qualifying child for head of household. Well, again, for EIC, you have to have that stipulation when we look at those tests. Did you provide more than half the upkeep for the home where the child is residing? Okay, so if that disqualifies the person, then they cannot take for the EIC. In the situation they're probably talking about there, grandma can probably claim the grandchild, I guess, for head of household if mom is not working at all and not providing any income or any support. Okay, it's kind of a unique situation, but we see it a lot more, and it's a lot more common with the people moving back in with their parents for multi-generational homes, okay? The other question I had was talked about excess Social Security. All I want you to remember on that one, the rule of thumb is that you are looking at how many employers that Social Security is coming from, okay? If you have one employer and they took out too much Social Security out of your paycheck, then you have to go back to that employer and they need to reimburse you because they took too much money. That is your single employer's mistake, okay? If you have more than one, or two or more, I guess we could say, employers, and when you go to put your W-2s together on your tax return, you find out that you paid too much in Social Security, then that's where the credit would show up on your tax return. Most common example I can think of, if we have a doctor, somebody that's very high paid, they have worked for 2 different practices as W-2 employees. When they go to file their tax return, they bring those 2 together, and all of a sudden on the tax return, it shows that they paid too much in Social Security tax. They would get it on their tax return. If that doctor only had 1 practice that they worked for as a W-2 employee, and then they received a W-2 with excess Social Security, they'd have to go back to that practice and get that money back. Okay. Let's see here. Okay. One of the things that came up, we've talked a little bit when we did Chapter 6. We talked about the education credit. That would be the American Opportunity or Lifetime. Some of the situations, and we'll cover it later when we get into the adjustments to income. There is a tuition and fees deduction. That is a kind of like a third. It's not a credit. It's an adjustment to income. So sometimes a situation may work out that is, especially if somebody is above the American Opportunity Credit, that you want to take a look at that lifetime learning credit. And depending on where the family's income is and how their itemized deductions work, you may be better off adjusting their income on page 1 at the bottom when we hit adjustments to income. Okay, it's touched on a little bit, but it'll be explained more when we do adjustments to income in Chapter 12. Okay, so that's kind of where that credit works together with the different scenarios. Okay, some of it has to do with phase out. Talked a little bit about that. When a family or the income, the adjusted gross income, gets to a certain level, there's some credits that phase out. You're not eligible for any longer. It's kind of a range. Starts small, gets bigger. Okay, so when that's the case, once you've reached that full phase out, you may have to move to another one. This is where the tuition and fees might come into play. Okay, all right, and procedural-wise, we had a question that was asking about retyping the bank account and all the times. Unfortunately, with the bank account, it doesn't autofill. It's up to you. I like you to get in the habit of typing in the bank account information in the main info, because that's part of the little bio things, the little bullet points that are in the workbook. It kind of says they would like to have their refund deposited, or maybe the case that they have, they want their the balance due taken out of their checking account on a certain date. So that's where that's in there. As far as your username ID, once you've created a 3-digit, 3-character or whatever, if you want to use your initials, once you've done that once, it should autofill. So, in my case, I use the first three letters of my last name, ELI. When I type that in, it will autofill right into that, so I don't have to retype all that information. Okay. All right. And the other thing I want to touch on this morning too is for those of you that can't get to the 9 a.m., I am willing to set up some schedules even for one-on-one brief Zoom sessions. I'm usually here well after office hours, other projects that I'm working on. So I am usually here. Somebody wants to do that, where I'd like to get them caught up. If there's problems that they're having, even software problems, things like that, please let me know. I'm happy to do that. I do the Saturday lectures as kind of a general information thing, but please, it's kind of the nature of an online course that a lot of it is done through email or the videos on YouTube, but I want to make sure that you're understanding the material. So please, make sure that you can do that, where we have a little bit more one-on-one if it's need be, or questions or whatever may be. Sometimes during the day with the appointments I have, especially this time of year, I do my other role besides working and doing taxes and teaching classes. I do teach other classes on Tuesday and Friday, one in the morning for 3 hours and one at night for 3 hours. And I also do the marketplace for healthcare and Medicare. So during the day, it's tough, but I am happy. I know I threw out there about the times. I'm going to keep it 9 o'clock. That's kind of what everything was on the beginning. But please let me know, after 5 or 6, if it works better, that you're not able to get to these, but you'd like to have that time with questions, we can set up an individual one-on-one with the Zoom. I have no problem doing that. I just want to make sure everybody understands the material. Okay? All right. Any questions at this point? You can turn off your mic and say, or if you'd like to type it in the chat, either one, let me know. Okay. And as I said, always on the other recordings, please, as I'm going through something, I'm looking for the input, what works best for everybody. Obviously, I can't accommodate everything all the time, but, general input and general points and stuff that may help the group, just like you're in a class. We want to have you treated just great. So, we want you to interact just like you guys are all sitting in a classroom right here with me personally. So I want to make sure that that's the atmosphere that we create. Okay. Okay, we had a question come in probably about the worksheet that was talking about the support worksheet. The first question when it talks about worksheet 3.1 is the worksheet for determining support. What funds belong to the person you supported, and it says enter total funds belonging to the person you supported, including income received and amounts borrowed during the year, plus any amount in savings and other accounts at the beginning of the year. That's when you're looking at that, and the question was for the support test without having beginning and ending balances of a person's accounts. If you don't have that, you need to get that information. Chances are, and again, I'm just kind of making this as a kind of a general summary, but chances are if it's a question of support, chances are that person's probably living, month to month, paycheck to paycheck, Social Security check to Social Security check. There's probably not a lot of money sitting in any bank accounts that you would have to worry about. We're mainly worried about that income that comes into the house for things that they have, Social Security checks, things like that. So, when you ask about account balances, my personal experience most of the time, I'm seeing people with, less than $1,000. So there's not a huge swing there. When you're looking for support, if you got somebody that's got $100,000 in the bank, chances are when we're working through this worksheet and their sources of income and pensions and stuff like that, they're probably not going to meet the support test because their income is such that they could really be supporting themselves or living on their own, so they can't be as a qualifying dependent on the return. Okay. All right. Any other questions that we have? Okay. I have been sending out, like I said, the answers to the exercises and quizzes as we go along. So just make sure that you have those are sent to you. Like I said, I'm sending out the PDF of the problems that has the federal and New York State most of the time because of the classes that we have in class here in Western New York. I am going to try when we get closer to the midterm, just because I have several participants in the class that are of various states. I'm going to try to see if I can adjust the schedule when we get closer to the midterm in the next week or so, that I'll probably add in there just a class time to talk about state considerations. I know I've had people that are in North Carolina. I have some people in Missouri. I have some people that are in Nebraska, Texas. So I want to make sure, I can kind of tell you how that works. And also that'll give me a chance to spend some time so you can kind of see if you're in one of those areas, if you have somebody that moves from New York into your state and they're your resident of the two, because that will be a valuable experience too. I see that a lot up here. I have a lot of clients that work with Homeland Security that are sent from the Canadian border up here down to the southern border and back and forth. So there's times that I do part year returns forms. So I'll try to create some examples so that you can see how on the state side those part years or the state residency works. Obviously, those in Florida, I'm not too worried because you don't have state taxes to file. So you have that luxury. Texas, same way, Tennessee. So there are several states that, this would not apply, but there are states where it does. And it's important to know because the one thing is with state returns, the way they work for part year, you don't want to have to be double dipped on the tax that you're paying. So if you're paying tax on your federal adjusted gross income in one state, there are adjustments on the other returns so that you're not paying tax again on another state where maybe you didn't live the entire year or you may have been a non-resident. Okay. All right. So we're going to talk about non-refundable credits. Okay. So we have our non-refundable credits, part 2. All right. In this chapter, it talks about we're going to extend what we talked about non-refundable. If you remember correctly, when you look at your forms and you look at your 1040, we're basically just covering that section, part 2 of the chapter, or excuse me, of the part 2 covers the all of the rest of the non-refundable credits. So if you look at page 2 of your 1040, there's that little section for non-refundable. So we're going to talk about all the ones that are in there. Now, there's a lot of material in this chapter that obviously is not applicable. You just don't do it. We write the textbook to try to explain as much as we can, so you have it for a resource library. As far as the practical use and what we see in 90% of our returns, these things just don't come up, okay? And I'll kind of talk about those too. I'll briefly go over them, but like I said, some of them are kind of narrow. You almost, if you will, have to have the perfect storm. So we'll kind of talk about that, okay? Remember, refundable credits, Energizer Bunny. They go on and on and on and on, okay? Non-refundable credits, those are our Pac-Man credits. They keep munching, keep eating till all the little dots and the little ghosts are gone, better known as our tax bill, okay? Once that tax bill is gone, our non-refundable credits stop, okay? Now, we have talked, there are portions of certain credits that are non-refundable that have refundable portions, okay? We kind of talked about that with the additional child tax credit and the American Opportunity Credit. So it starts out eating up our tax bill, stops at its portion that it would for the non-refundable, and the remainder may flow down to a refundable. So those are nice credits. They're important credits because basically there's money on the table that can be had. It's not going to disappear if you don't have a tax bill and you're not eligible for it, okay? First part we're going to talk about today is the Retirement Savings Contribution Credit, better known as the Savers Credit, okay? It comes up on the 8880 form, so that we have that. We're going to talk some more about the Child Tax Credit, Residential Energy Credit. This is a credit that tends to have 9 lives, okay? What I mean by that is at the end of every year, this credit seems to disappear, and then the 11th hour of the next year, before the tax year starts, or the tax filing season starts, it's reincarnated, okay? This credit is narrowed down. What this credit is, and we'll talk about it more, is that credit that you used to see when they ran those advertisements on TV. Hey, this is ABC Heating. We'll put you in a brand new furnace. Here's the price, and you could save $1,500 on your taxes. Well, that's what it used to be. This credit has shrunk considerably. Like I said, at the end of 16, and that's the law that we're using, this tax was expiring, or this credit was expiring. But you never know. Because with this type of credit, if you think about a state that maybe has many employees that make furnaces, or you have a state that has somebody that makes many windows, it might be the case that their representatives or their senators would try to get this back in because they want to keep that business for their constituents, okay? We'll talk about the adoption credit. We'll talk a little bit about the credit for elderly or disabled. And then you can see there we have some about alternative motor vehicle and plug-in electric drive motor. These are credits that we just don't do. Like I've said, I did in the excess of 1,300 returns last year. Not one that I sat with, and some of them are pretty involved, had anything to do with anything regarding their electric car, okay? So it's not a credit that we see a lot, all right? Okay. Now, as we said here, you can see that we're talking about these non-refundable credits, and you can see the sections that they're in. We're kind of talking about lines 51 through 54 right there on page 2 of the 1040, okay? Some of the credits, when we have some, especially when you talk about the ones on line 54, that is kind of a catch-all, hey, these are other credits that we might take, okay? What I mean by that, they're just not common, that they don't garner their own line on a 1040. So they're in the section. So sometimes when these, they're not on there, they're not going to say, hey, here's the line for adoption credit. I know I've talked about navigating on the 1040 pages is using your navigation to kind of start where you need to go. But this is the case where we'll talk about this because they're kind of hidden. So, but we'll talk about where they're at and how you find them. Okay. All right. The retirement savings contribution credit. Okay. Better known, like I said, Esther always talks about it on her radio show, that she calls it the Savers Credit. Okay. It is a non-refundable credit for lower income taxpayers who make contributions to an IRA, either traditional Roth or employer-sponsored retirement plan. Okay. The credit is available in addition to any deduction available for an IRA contribution. So basically what this is for households that have income that, I guess for lack of a better term, are kind of living paycheck to paycheck where things are a little tight. There's not that extra income sitting in the bank that they can just put into their IRA at the end of the year, or, they have, they're not able, because of the paycheck that they need to come in, they're not able to participate in a 401k like some people might with higher income. So they are basically, the IRS and the government has said, thank you for helping to fund your retirement, okay? They basically are extending this credit. We'll talk about the deduction or adjustment to income for contributions to an IRA and how that works when we do adjustments to income in 12. But, this is a credit that basically says, hey, we see that you're taking money out. We see that your income's not real great. Maybe this is hurting the family's budget just a little bit. We're going to give you a little extra credit and help ease your tax bill. On the W-2s, when we do a couple problems here, you'll see that one section in 14 talks about the contributions it'll have. Does this qualify for a 8880? That's the form that we're going to use for this, okay? On a W-2 in box 12, when we use that D code for contributions to retirement, that is something that would carry to this. And then, like I said, when we use the bottom of page 1 of the 1040, there's a place where we can put the IRA deduction for our contributions. This is something that would qualify for this, okay? We'll see how that form works when we do a couple of the problems, all right? As it says here, eligible retirement contributions, okay? All those different things, all the different ones that tend to start with 4, SEPs and simples for those self-employed people. Things that are done through some of the contributions to Section 4974 for TSPs. Those things are in there, okay? So there's a lot of things that qualify for this, all right? You just want to make sure, and again, it kind of goes back to the what we've talked about. When you're putting that W-2 in there, that really is the foundation. That's going to tell you where things are flowing to the 1040 and what they may be eligible for. So it's very important, if you see something on there that is a contribution to a qualified retirement account, we need to make sure that if their income falls in a certain range, that they can take advantage of the Savers Credit, okay? It talks about the retirement savings contribution credit is not available if either of the follow applies, or any of the follow, if applies. Again, we start to look at our household income, 30,000, okay? For single or married filing separate or qualifying widower, had a household 46, married filing joint 61. So again, if we think about a lot of our phase outs of certain credits, a lot of them are in that 100, low hundreds to mid 100,000 range. This one's much lower. So in order to be eligible for this credit, Your AGI has to be within these parameters, okay? Also, there's certain persons who made qualified contributions that they talk about. Were they born after January 1st, 1991? Are they claimed as a dependent on somebody else's? Are they a full-time student, okay? You see these bullet points in all the problems. You've probably wondered, well, why do I need to know that? This is where you start to know that, because it may be the case that they are or aren't eligible for that saver's credit because they were a full-time student, or something else may apply on this, okay? All right. As you can see here, most of the rate is based on their AGI and filing status. The credit that they can get decreases 50, 20, 10, and then a 0 as the AGI increases. So it's a pretty steep slope that they could, qualify for this, and then it really phases away pretty quickly as their income increases to that threshold that we just talked about. Okay, all right. Here's the form 8880 as it appears on the form that from the IRS. Looks a little different in our TaxWise software. You can see in the middle it has the table there that talks about phasing it out, based on their filing status and things like that. Talks about the fact that you cannot have taken any distributions from anything in the last 3 years, and you can't be a full-time student. So there are some parameters. It's pretty tight, but like I said, it's a credit that the IRS has determined, and the government that really wants to help out that low income so that they have the retirement, the saver's credit. Okay. All right, child tax credit. Okay. I know we had a couple of questions that were in there about qualifying child and what the child tax credit is. Also, I will talk a little bit, obviously, since we last met, the government has rolled out their new tax proposal for everything on there. Obviously, this is the infancy. There's going to probably be many amendments, many changes to it. But one thing they are talking about doing is raising the exemptions, raising the standard deduction, and then that would get rid of some of the exemptions and credits for the child, okay? Depending on the state you live in, this can help you, this can hurt you, okay? For some families where they have more than one child, the credit that's proposed, the law that's proposed is actually going to hurt a household or break even. It's not really going to help them. We went through a scenario last night with a young lady in class that she is married with 4 children. Because of the way the tax law works, at first it looks like she's going to get some extra in her refund, but then when we do the adjustments they're talking about with the standard deduction, the loss of the exemptions for children, even though they may increase her child tax credit and may increase or decrease the tax rate, she was at about a break even because of what she lost on her standard deduction and what she lost for her children's exemptions. So we'll keep you monitored. If you follow us on Facebook, I've been posting the stuff Esther's been doing on TV and radio and different things that talk about that, so that you can kind of understand, because obviously as you're doing taxes, you have to be able to react to what's happening in the world, okay? The child tax credit is a $1,000 credit maximum. So the IRS, I guess, has determined that it only costs you $1,000 a year to raise a child, okay? So they're going to let you have that as a credit, non-refundable. If there's any left over, then it will go into a refundable portion that we talked about in Chapter 5, okay? There's 7 tests that you see here for the qualifying child, okay? So we have the 7 that are there, okay? All right. So if you look right here, okay, look right here within this, we have our box for our 7 children, or excuse me, our 7 tests, okay? Shows the classifications for the credit. A lot of it: daughter, stepchild, foster child, okay? Brother, sister, stepbrother, we pretty much cover everybody on the family tree there. As I said, you have to be under 17, okay? So in the year that they turn 17, you are no longer eligible for the credit. We talked about a little bit at the outset when we were talking about that worksheet. They did not provide over half of their support or upkeep of a home, sometimes it's called, okay? They must have lived in the house for more than a year, or excuse me, more than half the year, okay? They can't be dependent on another taxpayer's, or excuse me, can't be claimed as dependent on the taxpayer's, or must be claimed as a dependent on the taxpayer's return. The credit, they can't do their own taxes and claim themselves for the child tax credit, okay? Does not file a joint return and was a U.S. citizen, U.S. national, or U.S. resident alien, okay? So those are the things to meet that criteria for the qualifying child. Kind of look at it, a lot of it's an extension of what we saw for the earned income credit, you know, because, again, we hear that term quite often with the qualifying child, okay? All right. This page kind of goes through a lot of different things. It talks about, you know, the exceptions to, you know, living with the taxpayer. You know, if they're away, say they're at a boarding school, or they're in the military, or they're in the hospital, or detention, a juvenile facility, you know, those still consider, if they're qualify as a dependent child, that they can be on there, okay? One thing we'll talk about too at some point, but you know, this is one of the things when you go to do that Form 8332 that we talked about earlier, is that when you release the exemption, say there's two separate parents, two separate households, and the mother has two children and she has agreed through the divorce decree to allow the father, the non-custodial or non-residential parent, to claim the children, well, she's releasing the exemptions and the credit to that father to claim on his return, okay? That's all she's releasing. She can still be head of household for the earned income credit because that's where they reside, but she won't then have the exemption or the credits on her return. She's given those and put them on the non-custodial parent, okay? In the main info sheet, when we do one, I'll kind of point that out again. That's where you'd pick number 2 for that code that says a child that does not live with you. So basically, they're allowing that person to be on the return, and that credit and the exemption against their income is on there, and then they have the credit too to help up the tax bill. Scenario we see this is that if we have divorced parents, the father maybe has high income, the mother has low income, so the mother has the kids and she's the custodial parent, she may have them on her return for the earned income credit. The father, having a high income, would not qualify. He does not file head of household. He's filing single. He doesn't get the head of household, but he does get the help of having the kids for the exemption, the child tax credit, to lower his taxable income and tax bill. Okay. Phase out. I see this one and I talk quite often with parents. They're kind of shocked when we get to that 110,000 married filing joint, and all of a sudden their kid's credit starts to fade away. Okay. That's just the way it works out for the income that's on there. All right. We have a modified, sometimes I'll call it MAGI, but modified adjusted gross income. These are things that we would do to that income to see where they qualify for that, okay? As far as claiming the credit, a little flow chart here to determine if that dependent status for 16, okay? Again, good little flow chart, great for when you're interviewing a client. You kind of know the questions you need to ask. Again, within the software, you can kind of know that as you're filling this out that you have to ask them those questions. And as I talked about with the earned income credit, we have that due diligence form, that 8867 that's on there. Again, we're probably going to ask them 3 or 4 times about qualifying children. The reason being is children on tax returns are where the IRS sees a lot of fraud for what credits are on the table. There's some sizable credits with the earned income credit, the child credit, things like that. So, you know, there's a lot of things that are done there as far as the different things with the fraud on there. Okay. All right. Okay. Any questions to this point anybody has? If they want to type them in the chat. Okay. Here's page 2 of the 1040. Okay. kind of talked about it earlier, but this is a great time to kind of go into it. So we have different things on there. If you look, this is that section that I'm talking about. Okay, in the software, it actually has a header that says that it is a non-refundable credits. This is where we're talking about it. Okay, so we have the different things that are there. All right, so if you take a look here, this is where I was talking about that line. Whoops. Okay. Okay, so we have this section right in here is where we're talking about that. Okay, and if you take it in a little farther, all right, this is at line 54. I apologize about the little thing there. That's where I was talking about. This is that kind of catch-all for some of the ones that we're going to talk about. Okay, so we're going to have those credits. You can see that box C that it talked about. It's blank. Again, the credit that we're going to talk about probably doesn't happen that often. So it's going to kind of be one that we don't have its own line on the return. Okay, but that's the section that we're talking about. Okay, all right. Again, there's some exercises in there. I'm going to let you do those and work through those just like I've done in the past. I'll send out the answers so you can see how you did on your calculations. So there's a lot of forms that we have in there. Okay. All right. Energy credits. Like I talked about at the outset of this chapter, it's a credit that for 2016 was supposedly the last year. Okay. However, 9 lives, it always comes back. I think there's been 3 previous years very recently where the energy credit, it has shrunk. It's a much smaller credit than it used to be, but there are qualifying things that you would have for it. Okay. It's a non-refundable credit available to taxpayers who have made energy-saving improvements to their home in the United States. Okay, I stress improvements. It is not a credit for when you build a new house that you put in the best windows, the best furnace. It's improvements, and we'll see on the 5695 where it talks about that. There's some questions that are on that form that would disqualify if it's a new build. Okay, now 2 parts to the 5695 where we talk about energy credits. Okay. It is a credit on the first page, or part 1, I should say, that is a credit that talks about solar, the wind turbines that you see, geothermal, fuel cells where they're taking solar and storing it, or any other way that they do that, that they're almost creating their own little electricity factory in their house. Don't see a lot of these. We see a few solar. I do see a few wind. I have some clients south of here that have several of the electric companies have bought the rights to their land to put a wind turbine on. And I do have one client that we did that is done geothermal. Obviously, he had a lot of time on his hands and decided to dig a very deep hole, but that's the way he heats his house is through the geothermal. Okay. These are very good credits, but when you start to look at it, it's a very expensive undertaking. Solar panels, wind turbines, geothermal, very expensive to do. Also very good credits, but you're not recouping your entire cost on the credit on your tax return. And again, we're talking about non-refundable. So, you know, it's not something that they're going to get. Now, in New York State, there are some extensions with refundable portions of the solar and wind that are very good. So when you couple them together, it is very beneficial to do these. But as I've told my classes, my in-classroom, you know, we're looking at an industry with all these alternative energy forms that is subsidized on both sides by the government. These factories, these companies, these producers of all these products for solar, wind, and geothermal, in order to stay in business, they get subsidies from the government. Obviously, as we see here, the consumer or the end user is also getting subsidies from the government. So you're kind of in a thing that, you know, they have to do that to sustain it and try to get people to partake in it. If at some point they pull the subsidy from either side of the equation, I don't know how successful it's going to maintain itself. But for right now, it's a very good credit. You don't see a lot, okay? However, we do see a lot with, and like I said, 2016's tax year was the last year for it. This is where we see most of our credits because we're talking about improvements to existing homes. They did new windows. They did a furnace. They did some new air circulation. They did some exterior doors, okay? So you can see the credit is there. However, we have to remind them that it is a $500 lifetime credit for all tax years after 2005. So basically, if they've used up this credit in years 2007, 2010, 2013, when we would do their 2016 return, they don't get the credit. Okay, I know putting a new roof on with the correct grade of shingles or steel, the steel roofs that they're doing now for energy conservation, they're not cheap. You know, there can be tens, thousands of dollars, but the credit is very small, and it takes a lot of different categories to even get to the $500 in 1 year. As you can see on there, for a qualifying natural gas, propane, or oil furnace or hot water boiler, it's a $150 credit. Yes, it's $150, but you know, I don't imagine, unless somebody knows the inside trick, I don't know of anybody that's ever replaced a furnace for $150. Okay, so again, very minimal credit. It still exists. Right now, it's not on the docket for the 2017 tax year, but doesn't mean 11th hour it won't come back in. Okay, we talk about the different energy improvements. Like I said, all these things are things that are really done to the exterior, the heating of the house. New doors on the inside don't count. Exterior doors, yes. Okay, so you have to kind of have that. They need to have a receipt that shows that it was of a certain grade as far as the Energy Star. I know everything has Energy Star on it now because it's just a standard, but they have to meet that and exceed that. Okay, like I said, here's the form, the 5695. Part 1, don't do a lot of those. You know, I've started to do a few more. North of here, there's some areas where people are starting to do solar farms because the energy companies have come in and asked them if they can do their land that's sitting vacant and put solar panels on it. Okay, but we see much more of it with the energy side as far as the furnace, the windows, the doors. Okay, so those would be there. All right. All right. Any questions to this point? Okay. All right. The adoption credit. Okay. I'm sure when you read this, you're starting to think, well, wait a second. I just did the child credit. So this is a kid that is my flesh and blood, and I've raised from an infant, and I only get $1,000. But if I adopt somebody else's child, I get $13,000. Well, you know, anybody that's gone through adoption or been part of the adoption process, it's not inexpensive. Okay, you're still going to get that credit for the child tax credit, but bringing that individual and adopting that individual into your home, then, you know, the government has deemed that they have given you this adoption credit. Okay. I will say about this credit, it is a great credit if you're going to look back on somebody's tax returns as a new client and you find out that they adopted. Make sure that this credit is handled well. Yes, it is non-refundable, where it is only going to eat up the tax bill, but as you can know from your reading and when we see the form in action, it is a credit that does carry forward. So even though you may have not used it all in the current tax year or even in the tax year prior to the adoption being done, it could carry forward for 5 years. Okay, very good credit. All right, so you can say that it's kind of a hybrid, kind of non-refundable, but kind of refundable too, because you don't really lose it after the tax bill's gone because you can carry some over. Okay, all right. The other thing it talks about in here with the adoption credit is that sometimes there are employer programs. My class said, hey, I never heard of anybody doing anything like that as far as an employer helping pay for an adoption. I said, Wendy's. Dave Thomas, who was the founder of Wendy's Hamburgers, he was adopted. You always saw they promote a lot of that. They had a program that if their employees would do adoptions, that they would match almost dollar for dollar their cost to adopt a child. Okay. However, that does two things, because it talks about in there that it would show up in box 12 as a T code, so that would reduce some of your qualified expenses that you could claim for the credit because you're being reimbursed. Okay. All right. So we talk about that in there with the adoption. Okay. Here's the expenses that count as qualified adoption expenses. Obviously the fees, the attorney fees, court cost, again, not inexpensive, traveling expenses. If somebody's going to South America to adopt a child, then it kind of ties into the next one. There are countries where you must go to a foreign country, adopt the child within the laws of the foreign country, and then there's no reciprocal with the United States on that adoption, so you have to re-adopt when you come into the United States. So you might have the expenses twice on the adoption, but that's just the way the laws and the treaties and stuff would work between the governments, okay? Things that you can't include that we've kind of talked about a little bit. If you get any money from the state or federal government program to adopt a child, you have to reduce your qualified expenses by that, okay? No surrogate parenting. This one, odd, but you don't get to take the credit if you're adopting a spouse's child. So I guess in the situation that I always think of, in the case of the Brady Bunch, when they brought the two families together, each of them could not take the adoption credit for the other three, okay? So you cannot adopt it in that situation, all right? We talked about the employer expenses, okay? And then any other program that you have there, right? Also on 2, says violate state or federal law. Obviously, if you're not doing a legal adoption and you've chose, I guess, for lack of a better term, the black market, you cannot take that as qualifying because you are breaking the law, okay? All right. We talked about the credit. It's $13,000, okay? $460, a lot of money, but again, a lot of it will carry over, okay? It is a non-refundable credit, all right? But that does have that carryover with the next 5 years, okay? So there's some different examples in there that you'll be able to go through. Special needs, okay? As it says down there, a special needs child is often a U.S. foster child who receives an adoption, something that makes them tough to adopt. The state really determines, or even the county, as far as what is a special need child. It may be based on their ethnic origin, maybe their social economic situation. Another one that comes up sometimes is twins or siblings that cannot be separated. So there's a lot of different things, and that documentation that you would get from your government agency, whether it be state or local, would really, they know to make that designation on there that's going to say this is a special needs, okay? So that's where you would have that, all right? All right. Talks a little bit about the filing status that's in there, okay? So where we have the case that we talk about the different things between single, married, filing, joint, and such. All right. Now, adoption credit and exclusion. Okay. Again, done on the 8839, line 54. Doesn't have its own line just because it's not as common as some of the other non-refundable credits. But it is a important credit. Great little thing here with the review. These are the bullet points that we really need to make sure we understand, okay? Record keeping, make sure, all right? Especially if there's a foreign child involved. You may be in a country where, credit cards and personal checks aren't going to work. A lot of the transactions done in a foreign country are probably going to be cash, all right? So in that case, you need to have the documentation, keep receipts and, paperwork and everything that you can so that you have that documentation to establish that this credit is something you can take. All right. Here's a W-2 example that from Steve and Greta Maple shows that there are adopting parents. Obviously, he works for Acme Packing Company, and his company has deemed that they would like to support it. So you can see here that we have his code T in box 12. Well, once we put that code in there, if you look up here, 2 things come into play. One thing we talked about at the outset with the question is Social Security in box 3 was maxed out, okay? Secondly, you can see box 1 and 5 are different. It's adjusted by his non-taxable benefit for adoption, okay? So as opposed to having $145,000, in box 1, he gets to reduce that by the $10,000 that was given for his adoption expenses. So he's able to take that and adjust his income on the W-2. Okay. The form, when we see it, when we do a couple of the problems, we'll talk a little bit more about it. But the form has all these specific questions at the top, and it's a lot of those things that we just talked about as far as what allows them to be there for the claim. Good problem here to review because it talks a little bit about the benefit from an employer. Okay. All right. Okay, so I'm just kind of going through the examples here. And again, these are exercises and stuff I'll want you to do just so you kind of understand. We'll talk a little bit more about some of the forms when we do problems here at the end of this time, okay? Okay. All right, so I am on page 7-56. The credit for elderly or disabled. Again, a credit that we don't see much of because it has to be the perfect storm, okay? It is basically a credit for those elderly and disabled taxpayer who are either age 65 or older, or retired or permanently disabled and have taxable disability income, okay? So again, age, disability income. The other thing is that it is for a very low income, okay? So if I look on my page here, I'm going to kind of jump ahead, the income limits, all right? So on page 758, it talks about the tax limits. If you qualify, you can take the credit if your adjusted gross income is equal to or more than this amount, okay? For a single person, $17,500 phases them out of this credit. Well, that's not a lot of money, okay? We consider poverty level in the United States is roughly $12,000 for a single person, all right? So, you know, we're not far above that. Also, if they have non-taxable Social Security or non-taxable pensions, like a military pension, sometimes that disqualifies them for this, okay? So it's a credit that is there for the elderly and disabled to help them out to lower taxable income, but the threshold that it stops is pretty quick. Think about two people, married filing joint, okay, where we only have one spouse that qualifies, $20,000, okay? Poverty level for a couple is right around $16,000. So again, we're not too far above poverty and with the income there. So, you know, these are situations that I said are very rare, but it is a great credit to find if you get that individual very low income. The one thing I will say, if we have income levels for a couple that is below $20,000, chances are, with the way that their income sources are, they're probably not going to need to file unless they have withholding. So they're probably not going to need this credit either. But it is a credit that is there for you to find to make sure if you have somebody that's of lower income that they pay little or no taxes whatsoever. Okay? It goes on a Schedule R, okay? So you can see that, and there's several questions that happen as far as the filing status and age to see if they qualify for this, and then it does the calculations based on their income that they have, okay? So you go through that. The last couple things here, alternative motor vehicle credit, again, and the credit for the plug-in electric car, it's in there because it's part of the 1040 and something that's on there, but we're not going to spend any time on it because we really don't have anything we have to do with that. Okay? All right. So what we're going to do at this point, we're going to take about a 5-minute break so everybody can kind of stretch. All right. And we'll be back with this. I'm just going to pause the recording. All right. Okay. All right, everybody, we're back. I got a set up here. We're going to do a couple problems. So if you have your workbook handy, I'm going to be doing first problem 7-3. 7-3 is Jimmy and Susan Randall. It's on page 97 in the workbook. Okay. We'll also be doing problem 8-2. So that has a couple things in there. But first one we're going to start off is with the problem 7-3. I have the Randalls. All right. So we have in here, we're going to start out, we have Jimmy, middle initials M, his last name is Randall. His social security number was in there as we started. We have Susan, her middle initials also M, same last name. Okay. We have her social. Okay. The Randalls are living at 78 Oak Street. Okay. And that is, we're going to say, in Amherst. All right. Jimmy has his email. Okay. We have a phone number for the family. All right. Okay. And again, as we go through these things, if you have any questions that come up, please let me know. All right. By the microphone, or you can do the chat there. Okay. For the birth dates, Jimmy was born 5/15 of 1969. Oops. And we have his wife June 18th of the same year. Jimmy works as a computer programmer. All right. And his wife is an office manager. All right. They've asked if we look at our bullet points. It talks about on page 97. The information I just was doing was on 98, but on 97, it talks about the fact that Jimmy and Susan filed a 1040A, and they take the standard deduction and would like to file joint. Okay. As soon as we hear 1040A, we know that they did not itemize because of that form. Okay. And they take the standard deduction, so we know that the form that we'll probably be filing them with. All right. Married filing joint. We have a couple kiddos on the return. We have Nicholas Randall. Oops. Nicholas was born 8/12/2002. Social security number. Okay, he is their son. Oops. He is their son who lives with them all year long, is their child. Okay. Now, if you remember, I talked a little bit about, one of the things I talked about was that if we have a situation, even in this one, where we would have a person that is releasing this claim. So even in this situation, say that Jimmy and Susan, this is their second marriage. Nicholas comes from Jimmy's first marriage, so he can release the exemption, okay? So they would stay on his return, okay, here for that, but what they're releasing is they're basically releasing, and you know, he is getting to claim the child for the child tax credit. He didn't live with them, so mom's letting dad claim the child, but it doesn't live with them. But is it somebody that does not live with them? So basically what happens here is he still shows up in the exemptions. You can see there's 3 exemptions here. Once we have income or a tax bill, we would see a child tax credit also down here. So you can see on this one, like I said, even though the child does not live with them, they are part of the exemptions here, okay? It would also be the case, all right. All right. It would also be the case that they would have a, down here, with the release of that, the child tax credit that we talked about today would maybe show up there. But again, non-refundable credits. So we don't have anything that we can use right here now because we've put no income in, but that would be the case as to what would be released there, okay? All right. So we're back there, and we're going to put the second child on there, a young lady by the name of Tammy. All right. And we have her social. This is their daughter who lives with them. Okay. All right, let me get this switched back because we're going to put Nicholas in there. Like I've told you, I always want you to check the EIC. The one thing that you want to ask a family, especially when they have children, okay, and they're working and they're of a certain age, ask them if there's dependent care. Okay, we can see in this problem on page 99, Humpty Dumpty Nursery, we have a little dependent care. All right, and we're going to put both of them in there. That's what the DC column is there. Okay, so we put that in there. We're going to say that they lived in New York all year long. So as soon as we type that in, you can see on your tree on the left here that it created all of our forms that we need to this point for our New York State. Okay, we're going to e-file this. In their bullet points, they said if they get a refund, they would like it deposited into their checking account. Okay, and again, as we talked on earlier, we do have to type this in each time because it is verifying it. Once there is a refund on page 2 of the 1040, you'll get where you have to type it in again. Obviously, it's trying to verify that that's the correct bank account that you want it to go into. Okay. The PIN, again, 5-digit number. I always just use their, I always just use their zip code. It's a very easy 5-digit. It is their electronic signature when we electronically file the return. Again, don't worry about the driver's license number. At this point, you'll have that from the client. This is what I was talking earlier. I use my initials. The first 3 letters of my last name for my initials for my preparer's ID. Once I've created that and typed in all the other information, you can see it populates everything there. Okay? And again, we're going to put in the date that we're preparing the return. Okay? Now, let's go back to our bullet points on 97. We've hit the one. If they owe taxes, they want to mail a check. We have their information that's going to be on the following pages. We talked about with the Savers Credit, again, we'll look at that. That's why we get that bullet point. Neither was a full-time student, nor did they have any distributions from any retirement plans in the past 3 years. Remember that. Retirement Savings Credit or the Savers Credit. We had a couple questions. I'm going to show you that on the 8880, but those are questions that are on there to see if they would be eligible for that. If they do end up with an EIC, we have on there that that was not disallowed in previous years because we would have to justify as to why they're doing it. We have one point here. Tammy was adopted by the Randall family in 2016. They incurred $10,800 in adoption expenses during the year. So we're going to be doing an adoption credit, okay? They paid dependent care for their children, okay? We're going to talk about that. There is a special circumstance in here that we'll have to talk about. And it says that their entire family had health care the whole year, okay? All right, as we talked about on the outset, if we go to page 1 of our 1040, first little thing we got to figure out is, did they itemize last year? Well, again, we talked about the fact that a 1040A was filed, okay? So no, they did not itemize, all right? The last bullet point, we talk about the health care. We go to our ACA. As I said, they had health insurance all year long. Must have been through one of the employers. Okay, so we're just going to check that off so that they don't have any penalty for that. All right. Now, what we're going to do next is we're going to put the W-2 in. Okay, as far as when I've done this, I like to go to the tree on the left and find my W-2. In this case, the first W-2 is for Jimmy. Okay. All right, we're going to check that that shows the address on the W-2. We're going to put in his W-2 number. All right, and he works for Continental Computers. He had income of $54,123.43, and he had withholding of $4,521. Okay, so we've put that in. All right, we're going to go down a little farther. All right, now we have, if we look at our paper one on 99, we have nothing in box 12 or 14. So we have nothing to enter here. 14, we have a default, the 414 HSUB. Again, I'm going to talk about that later when we do New York. It's kind of a New York consideration. For right now, we're going to delete that out. Okay, and here's that 8880. Okay. Why are some of the check boxes yellow? Okay, if a box is yellow, that means that you cannot check that box, that it's pre-calculated and comes from another area. Okay, so what I mean by that, if I tried, if you go up here to the top and you see a yellow box here, okay, if I try to check inside that box, going to give me an error. It says calculated entry. Right click to see your choices. Basically what it's saying is I did something else somewhere that is going to fill that in for me. I did another worksheet, or I completed another form, or I answered another question. Okay, so we can't check those boxes, the ones that are blank that are there that we can. Okay, so that's why some of them are yellow. All right, now again, talked about nothing in 12 or 14. Let's talk a little bit about that 8880. This return doesn't qualify for it, but I want to show you what that 8880 would look like on here. Okay. So if they qualified for it, we have our 8880. Remember, all those things that we talked about in the Savers Credit, okay? All those stipulations and stuff, here they are, right at the top of the form. You cannot claim this credit if either of the following apply. Your income was above, then we have those phase outs, 30,000 single, 46 head of household, 61 joint. The person who made the contributions was born after January 1st, 1999, is a dependent on somebody else's, or was a student. And then where we have questions, okay? Also, a little farther down on the form, we can see here, talks about distributions. So if we have any distributions that are here, okay? So if there's anything in the last 3 years, like I said, right in here, we can see all those distributions. That may disqualify them because it's saying, hey, you took money out, we're not going to give you credit for putting it back. This is only adding to your retirement, okay? All right, so that's a little bit about the 8880. Like I said, this return does not necessarily qualify for it, but I wanted you to be aware of it. So on your W-2, 2 places. You might have something, depending on the account, that the type of retirement account is, it may show up over here, and then you check the box that it qualifies for that, or you may have it over here where it would be in as a D code for a contribution to retirement. So you type in the D and then the amount, and it may qualify them for the Savers Credit, okay? All right, as we continue down here, they didn't participate in any retirement plan, and we see down at the bottom, that they had state tax held of $2,521.22. Okay, so we have our first W-2 done for this return. Now, also on this return, okay, if we remember, Susan also works somewhere. Now, what I like to do on these is, instead of going and finding everything, if you go right up to the top on your TaxWise, right up here, there's a little tab. Okay, so right up in the red box there, there's a little tab. Okay, that's the tab that we're going to use, and I'm just going to create a copy of this. So it gives me a brand new W-2, but with no information. So I can fill this out for the spouse. Then it shows in that yellow box that it is Susan Randall. Check the address. I can put the employer number in there. Okay. I can put in her income and her withholding. All right. This little box comes up. I do have always a lot of questions in the class. Why is this turning red? Okay. If we look at this little phrase right here, it's asking you to verify the withholding, the Social Security withholding, and the Medicare, but it's also asking you about the amounts that exceed Public 15 guidelines. Basically, what that's saying is that they're looking at this, and what you've entered down here in 1 and 2 aren't quite meeting what they think the withholding should be. You need to double check, or you need to talk to them about it. Okay? All right. So we're going to take care of that box and just check it off. Okay? Kind of an opportunity for you to counsel with somebody as far as their withholding. Again, we're looking on the page 100, the W-2 for Susan. We do not have any things in box 12 or 14. We go down to box 15, and we're going to have the information that's in there, and we're going to add the withholding. Okay? So we have their W-2s in. All right? Okay? Now, next thing we're going to do is take care of another tax document. On page 99 in your workbook, you have a Humpty Dumpty nursery. If you remember, on page 1, on the main info, when we put in the dependents, we checked that column that said there was dependent care. Okay? So we're looking at that. We checked that box there. As soon as we checked that, it created over here on the left a 2441, which is for dependent care credit. Okay? So we're going to use those two. All right? So we have the kiddos here. Okay? Hold on one second. Okay? So we're going to go to our 2441. Here we are. Credit for the child and dependent care expenses. In this case, we have Humpty Dumpty. Okay? A little limited on space, so we don't have to worry about writing Humpty Dumpty Nursery. Okay? We have that it is at 234. We're going to say Union Road. Okay? And that is, we'll use Amherst. Okay, we have an EIN number for them. It's on the little slip that they gave us at the end of the tax year to show what we paid. And we had $2,460.30 in dependent care. Okay, as it says down below, we see Nicholas and Tammy because we had checked them off in that box. We're going to put $1,230 for each of them. Okay, all right, now, taking a look at the 2441, no dependent care, we can see that their income's high enough that it's dropped to only a 20%. Okay, so the credit they would get, $2,460, we're taking 20% of that. That is the maximum. Okay, so their maximum credit on that is $492. Non-refundable credit, but their maximum is $492. Okay, so we have that. Now, as we talked in today's Chapter 7, the non-refundable credits, and as is the bullet point on this one, we have a adoption, okay? So we're going to go and take to our tree on the left. Again, I like to use the tree. Some people don't, but I like to use the tree to navigate. I know if I go to page 10, I go to my 1040, I can find my non-refundable credits. Okay, so I have that there. I can see my dependent care. I can see my child tax care. Don't see my adoption credit. As we talked about, it is one of those credits that falls on line 54. Not a common credit, doesn't garner its own line on the tax return, but we can go find it. Okay, so what we're going to do is we're going to go to our line 54. We're going to light up our box on the right, hit F9. You can see a lot of the credits that we talked about today are listed there on the little menu. Okay, but we're going to take our adoption credit. So we click on that. It takes you to our adoption credit form, our 8839. Okay, we have that there. So we're going to put in our information about Tammy, who was adopted. All right, so we have Tammy and her last name. She was born in 2005. Okay, our first question, was she born before 1999? No. Is she a special needs? No. Is she a foreign child? No. We do have an identifying number, Social Security number for her. Okay. And as it said in our little bullet points, the adoption, it took place and was finalized in 2016. So we talked about this is a credit that you can take, say that her adoption wasn't going to be finalized till 17, but they had started the process. Well, when we looked at those qualifying expenses for adoption, we could see that some of those would probably be upfront before the adoption was finalized. We can take those in the year prior. Okay? Now, we're going to work down the form here. This one's going to say, check if this is the first and only 8839. Okay? As somebody in my class used the example, we only have room for 3. So if you've gone to South America and you've decided to adopt an entire soccer team, you might have to do more than 18839, okay? But in this case, we just have Tammy. So this is going to be our only 8839, okay? Did we file this in the previous year? No, okay? Qualified adoption expenses. If you remember in the bullet point, it talked about it incurred $10,800 in adoption expenses. So that is our qualified adoption expenses. Okay, so we're going to put that in. All right, so we put that in. Our form that we'll see in the exercises did the calculations. If you take a look here, okay, it's giving them $7,097 of a credit. Okay, and the remainder of that credit, okay, after the $10,800 credit they're getting for qualified expenses, is carrying forward to 2017. All right, so if you look right down here at the bottom, we have our 10,800, 7,097. Then you can see right here it says 2016 credit carry forward to 17. But you can also see here that there is additional where it talks about maybe from previous years that credit is carried forward. Okay, that's that 5-year window we were talking about. All right, so we have all that. If we take a look at this credit and why there's a carry forward, we'll go to page 2 of our 1040. We take a look at that. I have my dependent care. I had a tax bill of $75.89 for them. I had my dependent care, $492 right here. You can see right here, as I was talking about, this is one of those forms that doesn't garner its own line, but on the return it told me, hey, I'm using an 8839 non-refundable credit. I'm going to eat up the last of my tax bill, then my tax bill is gone. Okay, so if we take a look, ate up my tax bill because now my $75.89 is equal to my non-refundable credits. I have no tax. So basically what happens down here at the bottom is we can see that we get into a little bit where we talked about refundable credits. In my payment section, all right, I have my withholding. And there's my additional child tax credit. So up above, it used the credits, my only non-refundable credits, ate up my tax bill, allowed me to take my child tax credits, my $1,000 per child, and still get that as part of my refund. So when it's all said and done, they end up with a refund of $9,722. Okay? So you can see how those non-refundable and refundable credits are working together and how they go on to the different parts. Okay? All right. Okay. Again, to finish off the 1040 and get last of the things here on the 1040 page 2, if I take a look, I do have to re-enter my banking information. Okay, so I have that here. All right, so I have that within my return. If we look at my tree on the left, I do still have a couple little things I have to clean up over here. My 8867, okay, so that's over there on the left that's circled, okay? So when I take a look at that and I go to do that, that's my due diligence form. 3 columns, earned income, child tax credit, American Opportunity. In this case, I have to answer all my questions here, and you can read through those, that you would ask your client as part of the due diligence to make sure that they have met the criteria and that you have asked them the questions as a tax preparer so that they are eligible to receive that child or additional child tax credit. Okay? On the state side, we're going to go through a little bit here on New York. This family lives in Erie County, actually in the West Seneca, okay, district. All right. So we have that for them. There's a question here that asks, do they have any financial accounts in foreign countries? Nothing in the Cayman Islands or Switzerland. Okay. So we're going to go take a look at a couple things. First thing is child and dependent care. If you remember from the dependent care, it is for children 13 and under. Nicholas is 14. However, he can be disabled. So we're going to say Nicholas is disabled. Okay. We have the last page here. So this is where our real meat and potatoes for the New York. We can see up at the top that we have our tax bill. Okay. And as you can see here in New York's, it's all payments and refundable. Up at the top here, we have our child credit, our family credit. Here's another refundable credit for our dependent care, our state withholding. So when it's all said and done, in addition to their $9,722 from the federal, they got $1,473 from the state. Nothing on the adoption, that's all a federal credit, but we do have a nice additional refund for the state for them. Okay. All right. And down below on here, we're going to file this electronically. It is a tax return. This one, you don't have to retype everything if you just check the box that says, I want to use the same account I used on the federal. You have to verify that it was a personal account and it was not going to a bank account outside the United States. And you want to allow our tax service to discuss the return. All right. And then if you have a New York State PETN or you receive one, that's where that will go in there. Okay. All right. So we've completed that return for the Jimmy and Susan Randall. Okay. All right. Okay. Any questions? Anything that I know we talked about some of the procedural stuff at the outset, but any questions on the return there? Okay. You know, you can always watch up in the corner, and I recommend that you do. Up here is that little refund monitor in the blue box in the top left corner. Watch and see what that does. Okay. Kind of see how it goes back and forth. All right. Oops, had somebody text in a question. Hold on one second here. Okay. All right. Okay, so let's move to the next one. All right. Okay, so we're going to start a new return. So if you want to go in your workbook to page 108, we are going to do Will Robinson. Okay, all right. And those of you that like old TV, I'm sure you know who Will Robinson is. And all of the characteristics of this problem will probably make more sense to you. Okay? All right. So, for Will Robinson, we're going to start out with his Social Security number in there. Again, I'm using zeros in the last four because I don't want to pull it up where it's already been done. So that's why I am using that. Okay. All right. Okay, hold on, got one more question coming in. Okay. All right, so we have Will Robinson. Okay, he's single right now, no spouse's name there. All right, he's living on 654 Space Lane. Okay, we're going to say Amherst. Okay. All right, we have that. We have his phone number. Okay. All right, we have that. His date of birth, 11/11/1970, and he works in delivery. All right. Seeing no dependents on there, we can have him filing single. All right. Bullet point shows that he did a 1040A last year. He lived in New York the entire year. Okay. We're going to electronically file his return. It says on here if he gets a refund, he would like to deposit into a savings account. If there's a balance due, he'll send a check. Okay, and he gave us the information. Okay. So very soon it will be Will Robinson's birth date, since he's born 11/11. So we'll have to celebrate that when we meet next Saturday. And we have information there. Okay, as it said, 1040A. So again, when we go down to the itemize, we're going to say no. All right. Bullet points. Now, as we continue, it says use the information for his 2016 return. Will has decided to see the world in an RV. He sold the house he has lived in for the last 14 years. He paid $65,000 for the house. He sold the house for $133,000. He has receipts for $48,000 in capital improvements through the years. Well, it sounds like we might have some capital gains from the sale of a home. He also sold some stock that he had. Okay, all right. And he had health insurance all year long. So we're going to make sure we check off his health insurance. All right. If we go to page 110 in our workbook, we have his W-2. So again, I'm going to go to my tree on the left, check the box. Took a look here. His address, he must have had another address or they had it incorrect. I have to reproduce what is in there. So I am going to put in his address as it shows up on the W-2. Okay. We have his employer number. Okay. He works for okay. And we have the address for Lightspeed. Okay. We have his wages as a delivery person, $7,001. Okay. And we have his withholding. All right. Now, we can see in box 12, we have a D. This is what I was talking about earlier, would be one of those ones that his income, if it was below $30,000, he might qualify for the saver's credit. Well, you can see up here in boxes 1, 3, and 5 that we have taxable income in 1, then what he gives and shows that he contributed towards Social Security and Medicare. Well, it's higher by the $3,000 because that is pre-tax dollars, so it's lowering his taxable income. All right. Down here in 12, we put the D in. As soon as I did that, if I look at my tree on the left, I can see that it made an 8880. Well, this one doesn't have a blue check or red exclamation point because his income up here in box 1 is too high. We remember, roughly $30,000 is what he would have to have in order to qualify for the saver's credit. Okay. In box 14, this shows that he had some New York State disability insurance in the value of $31.20. Okay. And that New York State disability does not qualify for the Form 8880, so we're going to take that out. Okay. So we can see right now he owes some money. So if we go take a look, like I said, I'd like you to start learning to watch the blue box up here in the top corner. You can see that he owes money. All right. Obviously, your client that you may be having sit in front of you would have that, but that is one of the things that I want you to start to watch. Okay. All right. So now we're going to do some capital gains. Okay. If you look at the bottom of 110, he has a 1099B there. Okay. So the disability, that was on the W-2 in box 14. You look where it says NYSD1. So on page 110 on his W-2, that stands for New York State Disability Insurance. Okay. All right. So we have that. Okay. All right. Okay. So we're going to go 1040 page 1. As I talked about, we're going to go down to line 13. We have our Schedule D. Okay. So we're going to go in there, hit F9 on that box. Once we light it up, it's going to give us our Schedule D. Okay. Just like the one we saw in the book. Okay. In the textbook. All right. So we have that D. We can see the top, part 1, short term, the bottom, long term. Okay. Remember, I talked about that one line. If this is a new client, we want to make sure that if there's any short-term or long-term losses from last year, that we enter that in there so that can be in the calculation. In this case, we didn't have anything. Okay. Now, as I said, everything goes on the D, but nothing goes directly on the D. Okay. So we're going to go into his short term. All right. And I want to use this box right here. So where it says short-term totals, we have that. I'm going to hit F9, and it's going to bring up what is called a capital gain worksheet. So I will select that. It's going to give me the sheet that you see on the screen right now. This is where we're going to do all of our capital gains. We're not entering it on the Schedule D. And as we talked about with sales of stock, it's not going to go right on the 8949. We're going to do it here, okay? So if you look at his 1099B, now, little quirk with the software for you, okay? I want you to take and roll up a little bit. If you do that, you're going to see this red print up at the top of the paper for the Schedule D worksheet, or capital gains worksheet, and I have A, B, C, D, E, F. Shows me all of my classifications. So in this case, we look at 1A, we have 250 shares of Moon Pie Incorporated, okay? All right. We take a look at that, and we look at box 2. Box 2 states that this is long-term, so we know we're going to use D, E, or F. Box 3 states if checked, basis reported. Okay, so this is that it's checked. So up at the top, if we take a look, that is a code D. All right. Okay. Now, we have in here that he acquired it 2/14/2005. Okay, so we're going to type in 2/14/2005. 1C out of our 1099B form shows 3/11 of the current year, which is 2016. Okay, he sold that for $2,500, and his cost was $250. What he paid for it, again, all off the 1099B, no wash or adjustments. So he shows $2,250. And if we take a look at the far right of this worksheet, we can see our gain or loss, and it shows us S/L, short-term, long-term. All right, so that D code gave us that it was a basis reported, so the IRS knows. We have our 22, all the information. We have our gain, and it was a long-term because of the dates, greater than a year. Okay? Now, if we go to our tree on the left, okay, we take a look. It shows now, right here by our capital gains worksheet, it created an 8949. Remember from our reading, for each the A, B, C, D, E, or F, each one of those has to have its own 8949. In this case, you can see that it made an 8949 for a D. That's what the stock for Moon Pie we did. Okay? Also up here, you can see on the Schedule D, we have some blue check marks. That means now that Schedule D is being used because we had some capital gains. Okay? So, let's go take a look at each one of these. First, we're going to go 8949. This looks just like what we saw in the book. It has our 8949. It is a Part 2 because it was long-term, held more than a year. Our D code that we used with the box there. And then down below, we can see our stock listed. Again, yellow numbers, yellow boxes, okay? So all those things are pre-calculated. We can't change anything on this. We would have to do that on our capital gain worksheet on the left, all right? If we go to page 1 of our Schedule D, we can see up here in the top, no short-term gains or losses, okay? Great. If we go down below, we can see on the Schedule D all of our transactions, okay? We can see on this line here that we have our totals from the 8949 with box D checked. There shows our amounts and our capital gains, okay? All right. To take that a step farther, all the way back to the 1040 page 1, we have a capital gain, $22.50. So basically we'd use that capital gain worksheet, okay? That would give us all the information, all right? So we're going to clean up a few things here. We take a look at the 1040 page 2. Says he owes money, but we don't want to have it taken out. He's going to write a check. This underpayment of estimated taxes, we're going to do the date. We're going to do the amount. And we don't have his history, so we just kind of F3 to get rid of that, okay? So clean that up a little bit, all right? New York, I'll let you do that on your own. Won't talk about it. One thing I want to do, though, okay? We're going to talk about that. Yep. Okay. The question came up, are you going to include the sale of the house that was in the bullet points? Let's read through that, okay? Because that's my next thing. So we're going to go back because that would even be reported as a 1099-S, okay? So what I could do, if he got that, I could put 1099-S here. Now, let's read it. Will has decided to see the world. He sold the house he has lived in for the last 14 years. He paid $65,000, so there's our basis. He sold the house for $133,000. He has receipts for $48,000. Okay, so if we take and adjust his basis, the $65,000 plus the $48,000, $113,000. Sold it for $133,000. So he has, okay, $20,000 in gain. However, we don't have to report it. Why? He lived in that house for the last 14 years. He met 2 criteria. Even if he didn't, it is less than $250,000, and he lived in it at least 2 of the last 5 years. So we don't have to report it on our tax return, okay? So there we can kind of see he met all the criteria. Kind of put in there as a trick a little bit, but it's to make you think about that criteria for selling your primary residence. Have to go through the problem. As soon as I hear that it was his house that he lived in for the last 14 years, we're able to exclude it, okay? All right, so one other thing I'm going to show you. He had bought, Will Robinson had bought some Moon Pie stock, short-term stock, okay? He bought it at the beginning of the year, and he sold it in October. He sold it for $1,000, but he bought it for $10,000, okay? So he has a $9,000 loss, all right? Okay, so that being said, we now have a short-term A, 89.49, all right? We also have a short-term loss of $9,000, a gain of $22.50, okay? So that means if we take that away from it, we should have on our page 1 the $9,000 loss and the $22.50 in capital gains. $67.50 should show up. However, remember, you can only take $3,000 a year. So if I get here to my capital gains, I have only my $3,000 loss. I can't take any more, okay? Now, if we take a look and you go to your tree and light up, okay? All right, talks about calculating on your Schedule D your carryover, all right? So it talks about next year that he can have some carryover. He's got some short-term carryover losses that he'll be able to use, all right, with the calculation there, all right? Sale of the home, there's a place here for capital gains, and again, we didn't use it on this one, but we could use it if we had to, all right? Okay. All right. Okay, so we have that. All right. Any questions on that one? Now, I'm going to show you one other thing too, because this is the only thing that goes directly on the D. So let me clean this one up a little bit. I'm going to get rid of our other moon pie. Okay, so we have again that gain short term. But let's say new client comes in to see us. We've never seen him before. We look at his return. He has a loss carryover of $7,000. Okay, so we would put it in there. That would help his situation because he had a loss from another tax return that we did not do. We can put that $7,000 loss. You can see that that makes for him to have a net loss of $4,750, which again is greater than $3,000. So we're going to have a little bit carry over to next year, and that would carry forward for us when we do his tax return within our software. Okay. Now, the other thing that I am going to talk to you about here. Okay. All right. And whoops, I forgot to put in his withholding here. Okay. Now, one thing I'm going to talk to you about, tax law, okay? What they're talking about, all right? Now, they're talking about doubling the standard deduction. And in this case, for a single person, Will Robinson, making $73,000, it's going to help, okay? First thing that's going to happen is if we watch, all right, what I want you to do is watch what I do here, and I want you to watch up here in the left corner, that little refund monitor, okay? So, if we take, and I make his, basically he gets to double his standard deduction now, okay? So, person in this situation, you can see it went from the $5,045 you owe and dropped down to $3,432. Pretty good deal, okay? Also, what's going to happen is he is in a 25% tax bracket, so based on his taxable income, his tax bill of $97.91 is going to be much less because half of his income roughly is 25%. All of it is going to be taxed at 15% or less. So when it all nets down, he might only owe $2,000. You can see how the tax law would be very beneficial to him. It's not as beneficial, like I said, to somebody that is on with a family, with children. Okay? All right. So that's what I have for today. Any questions from anybody today, or any questions on that problem? I know like I said, I just wanted to cover today the portion that talked about stock transactions on the returns and within the chapter. We'll talk about the other stuff when we get into self-employment and the rental properties. Okay. All right. Okay. If there's no questions, again, today was recorded, so you'll be able to go online. It should be going up, not by the end of the day, first thing tomorrow. And I will make sure to mail out the links to everybody and the homework assignments. So thanks for being with us today. Again, no questions. Look forward to seeing everybody next Saturday.